Thank you everyone for attending. We're happy to see some familiar names on today's webinar, and welcome to those of you who are joining us for the very first time. During today's discussion, we provide answers to the top 10 questions we get from our lender, bank, and credit union clients when trying to better understand appraisals. As you know, appraisals are filled with a lot of terminology and are constantly changing. Let's face it, they can be downright confusing if you don't have the proper knowledge and tools in place to understand the document in its entirety. My name is Joni Pilgrim, and I am co-founder and director of Sales and Business Development at Nationwide Appraisal Network. I will be moderating today's webinar along with our presenters, Christy Connolly and Kevin Johnson. With that, I'd like to take a minute to introduce them. Christy started in the appraisal industry 12 years ago, managing a busy appraisal firm in Philadelphia while completing her apprenticeship and becoming a certified residential appraiser. After several years of appraisal fieldwork and eventually relocating to Florida, Christy decided to lend her expertise to Nationwide Appraisal Network. She started with NAN as a staff appraiser and quickly moved into her current position as Director of Quality Assurance and Compliance. In this role, she oversees the direction of our elite compliance task force and works with our legal team to effectively manage our policies and procedures. Our second presenter, Kevin Johnson, came to us from the West Coast with more than 24 years of experience in the mortgage industry, including a diverse background in wholesale and correspondent lending, as well as underwriting and operations. Kevin's role at NAN is vital in developing sales and client relations. He leads the onboarding process as well as ongoing training and support for our new and existing lender clients. Before we get started, let's take a quick poll to see who's with us today. Give me a moment. You'll see the screen change as I select the first poll. If you would kindly submit your answers, and then we will close the poll and get moving into our top 10 questions. We have lender, credit union, AMC, realtor, or other as the options. We'll give it one more minute. All right, we're going to go ahead and close the poll out. And with that, Kevin, I'm going to hand it over to you to get us started.
Great, thank you, Joni. So what's on today's agenda? Well, we're going to start by introducing the appraisal process as a whole. We'll touch upon some recent changes in the industry. And finally, we'll dedicate the most time to answering the top 10 questions that loan officers and processors are concerned with when trying to read, understand, and explain appraisals. We surveyed our clients. We asked loan officers and processors what questions they had. And then we spoke to branch managers, regional and national sales managers, and asked them what kind of questions they get the most from their team. We compiled all that material and put together the 10 most popular questions on this topic. We are hoping we can clear up some common misconceptions and some confusion. So Joni, how about you start us off by describing the appraisal process as it stands today?
Well, as we all know, there have been significant changes to the appraisal process in recent years. Aside from the Dodd-Frank, which eliminated certain communication with the appraiser, there have been many updates from Fannie Mae, FHA, USPAP, and underwriters. First, we had the 1004MC, which was added as a required addendum to most residential appraisal reports. Next, Fannie Mae implemented UAD, and with that came a brand new way of reporting for appraisers and reviewing for underwriters.
Then FHA soon followed suit and required UAD formatting as well. Next came submission to the UCDP and navigating through the new world of warnings, soft stops, and hard stops. I know we're all familiar with the disclosure and delivery requirement implemented last January, where creditors must provide a copy of all appraisals and other written valuations to their consumer.
Yes, we sure are, Christy. And with this new regulation came the responsibility of lenders, banks, and credit unions to be able to provide an explanation of the appraisal and other valuations to the consumer. And this is a large part of why we're hosting this webinar today.
Right, and finally, the most recent change that has created a lot of buzz in the industry is Fannie Mae's collateral underwriter. With all of these updates comes a whole new world of appraising and requirements that appraisers must learn and meet.
So what's the purpose of all these changes?
Well, the main purpose is to enable underwriters to make better informed lending decisions. Lenders rely on appraisals to analyze the risk in lending their money to a borrower using their property as collateral. The appraiser is their boots on the ground, their eyes and ears to report every aspect of the property that impacts not only value but also marketability. If the borrower defaults on their loan, will the equity be there? Will you be able to sell the property and recoup what you've invested? Part of the appraiser's job is to provide all of this information within the appraisal report so the underwriter can make a sound lending decision. Christy, why don't you take a minute to explain what an appraisal is? I think this will really lay out the foundation for understanding the report as a whole.
Well, put simply, an appraisal is an opinion of value. There's a common misconception that appraisals are an exact science, which is not the case. The appraised value and information contained in the report are the opinions and conclusions of the appraiser signing the report. If two appraisers complete an appraisal on the same property on the same day, the values will likely not be exactly the same. In order to understand the appraisal report, it's essential to be well-versed on the industry standards and requirements. We want to cover some of these appraisal requirements from different entities that must be met. Your underwriter, Fannie Mae, Freddie Mac, VA, and FHA all have their own specific requirements that the appraiser must meet and take into consideration when they're completing the report. Then, of course, there's USPAP, the authority on appraising, which reflects the standards that appraisers must follow in order to maintain public trust in the appraisal practice.
That's a really great overview. And before we get into the top 10 questions, let's take another quick poll and see how confident are our attendees when it comes to explaining and understanding appraisals. Just give me a quick second here, and I'm going to launch the second question. If everybody wants to take a minute and submit your answers, we would love to hear from you. We have very confident, confident, somewhat confident, I can get by, or not at all. Okay, we have some answers still trickling in. We'll give it a couple more seconds. All right, I'm going to go ahead and close the poll. And Kevin, I'm going to hand it back over to you.
All right, well, let's get this countdown started. The 10th most popular question we received revolved around gross living area. We got questions about heated versus non-heated spaces, finished versus unfinished basements, and even porch and patio areas. So, Christy, what is the appraiser actually considering when they talk about gross living area?
That's a great question, Kevin. Let's start with defining gross living area, commonly referred to as GLA. GLA is measured by the appraiser during their inspection using the exterior building dimensions per floor. Sometimes upper levels will be measured from the interior if the appraiser isn't able to access them from the outside. Enclosed porches or finished spaces above grade can be included in GLA if they meet certain requirements, such as having a permanent heat source, being finished to the same quality as the main dwelling, or obtaining proper permits. Without these items, the impact on value will be considered and noted in the report. However, the area may not be included in the GLA.
Christy, let me ask you a follow-up question. Why is a basement or a level partially below grade sometimes not counted in the GLA and in the overall room count? You know, I used to live in the Pacific Northwest for many years, and unlike here in Florida, we had hills. And we had a lot of what we used to call daylight basements. Christy, can you help explain the difference between valuing above grade versus below grade square footage?
Absolutely, Kevin. Let me define these two areas for you. Above grade area refers to that finished part of the dwelling that is above the ground line or grade of the earth. Think of the first floor and any floors above. Below grade area is usually defined as the area that is all or partly below that ground line. Think basement space. Even if that space has windows, it is considered below grade. Above grade and below grade are reported as distinct areas in the appraisal, and the appraiser will value them separately in the sales comparison grid. Only finished above grade areas can be used in calculating and reporting above grade room count and GLA.
That's right, and Fannie Mae considers a level to be below grade if any portion of it is below grade, regardless of the quality of its finish or the window area of any room. Therefore, a walkout basement with finished rooms would not be included in the above grade room count. This would be given value as a finished basement.
Now you may be thinking, wait a minute, I've seen properties partially below grade with walkout basements considered in the above grade GLA.
I know we've all seen that, Kevin, and of course, as with most things, there are exceptions to this rule. There are times when an appraiser will deviate, which largely depends on the geographic area and specific property type. If it's typical in a market to consider a daylight basement as above grade GLA, you will see this reflected in the appraisal. As long as the appraiser is consistent when reporting the subject property and the comps, as well as explains how this was done in the report, it's acceptable and will be a good indicator of value.
You know, that brings up a great point. As most everyone on this webinar knows, the lending world is full of rules and exceptions. This is why it's vital to have a solid relationship with your AMC to help guide you through the world of exceptions. Okay, so we're off to a great start. Let's keep the questions coming. Moving on, the number 9 question is a topic that I personally have struggled with over the years, the cost approach. Christy, can you explain what is the cost approach and when it is used?
Sure, Kevin. The cost approach is another method an appraiser may use to develop an opinion of value. In a nutshell, it's a breakdown of what it would cost to rebuild the property today if it were destroyed. But it's not that cut and dried. You also have to take into consideration the value of the land and deduct for any depreciation.
That's right, Christy, and I feel like there's a common misconception with the cost approach. The cost approach is a valuable approach to use when appraising newer homes that might have little or no depreciation. However, for homes older than a few years, it's not very reliable. Some underwriters still want these completed regardless of the age of the home, and that's when we start running into confusion with our clients and their borrowers. There is a big difference between the cost of building a home today versus 30 or 40 years ago.
Okay, so why is it completed then?
Well, like Joni just mentioned, some lenders still require this, even though Fannie, Freddie, and FHA do not. If it's a lender requirement, the cost approach will be completed regardless of the property's age. I think the easiest way to explain this is simply to break it down. Let's start with the example that you see on your screen. We start with the site value. This is the value of the land minus any improvements. It's typically determined by vacant land sales in the market area. Next, there's the cost to construct the dwelling. This can be a confusing section because it's often misinterpreted that this cost per square foot should be what the home's value is per square foot, which is not the case. This is showing what it would cost per square foot to build this home today as new construction using today's materials. The age of the home has not yet been taken into account, but we'll get to that in a minute. After this, the appraiser will add any additional improvements and what their cost new would be. This particular property has a porch, patio, screened pool, fireplace, and boat dock, which the appraiser is estimating would be $85,000 new. Right beneath this is the cost for the garage or carport. This is again showing the cost per square foot to build new. These items combined give you the estimated cost if the property were built new today, which for this property is $221,050. Now comes the fun part. We have the depreciation, which takes into account the age and condition of the subject, as well as any functional or external obsolescence, such as railroad tracks, commercial influence, or funky accesses to a bedroom through a bathroom. In this case, the property had functional obsolescence due to being a 2-bedroom property, which is not common in this market. That, combined with the physical depreciation due to the age and condition, is estimated at $40,518, which is then deducted from the cost to construct new. There's one last thing to do in order to get an estimated value of the property through the cost approach. The as-is value of site improvements, which could include driveways, private wells, or sewer systems. Some appraisers include these items in the site value or additional improvements above, so it may be blank. As long as they're including this and are consistent, it's okay. All of these items you see provide an estimated value of the property through the cost approach. This property had an indicated value of $403,032.
Right, and for residential appraisals, the sales comparison approach is almost always the driving force behind determining current market value, with the cost approach simply lending additional support. Thanks for that breakdown. I think that was very helpful.
You know, many of the questions we received were about comps, and why certain sales were used as comps and why others were left out. So let's start to answer some of these. Christy, the number 8 question is, why do appraisers sometimes use comps which are much farther away instead of using recent sales in the same community?
There are various reasons why it would be necessary for an appraiser to do this. Sometimes there are recent sales close to the property being appraised. However, they're not similar properties. A sale does not equal a comparable. You could have a house next door to the property being appraised that sold the week prior, but would not be used as a comp because it's a different design with large variances in GLA, condition, and amenities. Oftentimes in rural areas, there's low market activity with a shortage of sales available, so the appraiser must search further in distance to locate sales of similar properties. Another reason would be if the property is unique to the area. There may be a very active market with lots of recent sales, but the only sales of geodesic domes with in-law suites are 18 miles away. This is where the appraiser's knowledge of the market area comes into play and is crucial.
You know, some of the most difficult appraisals to do, and the ones we get probably the most questions on, are those rural and unique properties. You know, that 50-acre ostrich farm or that geodesic dome. Our number 7 question is, how are rural and unique properties appraised?
Well, as we all know, appraisers face unique challenges when appraising properties located in small towns and rural areas, or properties that are unique in design. So much so that Fannie Mae released a lender letter addressing these challenges just last year. What we also know is the availability of suitable sales for comparison can be challenging due to limited market activity. My favorite example that I use a lot is the log cabin on 40 acres in the hills of Montana. An appraiser can only use what is available to them, which sometimes means the comps will be dated, distant, and have large adjustments.
Exactly, Joni. It's common to see comps as far as 20 miles away, 1.5 years old, and with over 50% gross adjustments. Rural areas or unique designs are also challenging for the underwriter since they don't fit into that neat little appraisal box where every comp is within 1 mile, sold in the last 6 months, and has minimal adjustments. In these cases, it's important for the appraiser to locate comps that demonstrate the same dominant features as the subject. The underwriter needs to see that the property is marketable and the value is supported in order to make their lending decision.
Okay, here's a question I'm sure most loan officers and processors have heard from a borrower sometime. How can the appraiser really know what my house is worth? I mean, they were only there for like 20 minutes. Christy, let's give everyone some background on the actual appraisal process so that they can better answer this question in the future. The number 6 question is, how is the value of my property determined?
This is an understandable question because most of the appraiser's work is completed in the office doing research, which is not something that the borrower sees. The appraiser researches the market area to determine if property values are increasing, decreasing, or remaining stable. They need to know the neighborhood trends and what the current inventory of available housing is. They'll research public records to obtain information on the property and to ensure it complies with local zoning, among other things. During the visit to the property, when the appraiser completes their inspection, they physically measure the property. This is where the GLA is obtained, not from public records or the tax assessor. During the inspection, the appraiser will note materials in each room, condition, and any amenities or external items that would impact value. For example, railroad tracks running behind a gas station across the street or a really nice ocean view. Once the appraiser has inspected the property, they begin their search for comparable sales through the MLS and other local data sources. These properties will be as similar as possible in regards to location, design, GLA, room count, condition, and amenities. They may also talk to local real estate professionals active in the market. Once comparables have been selected, the appraiser will drive by each of them to observe any influences that may impact value. Once all of this research is done, the appraiser then completes the appraisal report and develops their opinion of value.
Thanks for clearing that up, Christy. You know, as you guys know, I used to be an underwriter many years ago, and one of the most important parts of the appraisal to me was always the comp grid. Can you help explain how and why adjustments are made?
Yes, Kevin. In developing an opinion of value, the appraiser considers recent sales of similar properties, which we know as comparables. Rarely are two properties exactly the same. Therefore, the appraiser must account for differences between the property that sold and the property being appraised. These differences are reflected as adjustments. Adjustments are added or subtracted from the sale prices of the comparables in the comp grid to indicate an adjusted sales price. The adjusted sale prices of the comparables will reflect the probable range of value for the subject.
Christy, why don't you walk us through some common examples?
Common adjustments that you'll see in the grid are for GLA differences of 100 square feet or more, a one-car garage versus a two-car garage, varying bathroom counts, different amenities, and variances in quality and condition. A confusing adjustment since implementation of the UAD is that for quality and condition. The UAD requires the appraiser to utilize one of 6 options for these 2 items. Properties must be reported with the most accurate overall rating. This means that the property being appraised and a comp may both be an overall C3 condition. However, the comp may have some inferior upgrades, so there will still be an adjustment to reflect this. In these cases, the appraiser should have comments clearly explaining this in the report. And you can see in this example that the subject and all the comps are in C3 condition, but comp 3 has a positive $10,000 adjustment, which means it has some inferior upgrades when compared to the subject. So that adjustment reflects that.
And ideally, all features and amenities the subject has will be bracketed by the comp. While this is not an appraisal requirement, USPAP, FHA, Fannie Freddie, they don't require bracketing. It is typically an underwriting requirement for the lender. If bracketing is not possible, the appraiser should explain why in the report.
Okay, we are halfway there. Our next question is one that we have heard a lot, especially in recent years. The number 5 question is, why does an appraiser use short sales and foreclosures as comps when there are arm's length sales available?
When the housing market crashed, it created a lot of distressed sales and bank repossessions that still impact today's market. An appraiser is typically appraising a property for current market value. If the current market has a significant percentage of distressed sales, they will be a factor when determining market value. If 50% of the sales are distressed, that's representing half the market. It would be misleading for an appraiser to ignore that and to only use arm's length transactions. It's the appraiser's job to do their due diligence and select the most appropriate sales as comparables. If the appraiser feels an REO or short sale is the most appropriate, they will use it and should support the use within the appraisal with data regarding the prevalence of these sales and the impact on the markets they are having.
Hey, Christy, you spoke earlier about the condition of the property. How about we go into that a little deeper? Our number 4 question is, what determines the quality and condition of the property?
The quality and condition are determined by numerous items, including the age of improvements, materials used, updates or upgrades, replacement of mechanical systems, and deferred maintenance. We might assume that certain updates or improvements will affect the appraised value, but the results oftentimes are surprising. Improvements are valued based on market data, not what they cost to complete. The market will show what typical buyers will pay for specific improvements and amenities. It will vary from market to market and state to state. For example, an in-ground pool in Florida will be worth a lot more than an in-ground pool in Wisconsin, or a garage in Manhattan will hold more value than a garage in Buffalo. Examples of home improvements that will have a major impact on the appraisal, regardless of the region, would be additions to the home, including baths and bedrooms, or major structural repairs, such as stabilization of a crumbling foundation. The market expects items to be upgraded over time to keep the property in average or better condition. Without replacing or updating items when they're in disrepair or outdated, the home's value will suffer. Some improvements, like removing a bathroom to expand a closet or combining 2 smaller bedrooms into 1 large one, can actually lower the value.
Less significant improvements like cosmetic upgrades can impact the value depending on what they are, but oftentimes won't provide an increase the borrower expects. For example, replacing hardwood flooring with tile will not likely impact the value, as this is more of a personal preference than an upgrade. On the other hand, if you replace burnt orange shag carpet with top-of-the-line marble, that will impact the overall condition of the property, which is considered in the value. Other items that would improve condition ratings and impact value are rehabbed baths, new siding, or replacement of a worn roof. One important item to note is on page 1 of the appraisal report. In the improvement section, the appraiser reports updates to the subject.
The first sentence you see here is in UAD format where it's only referring to kitchen and bath updates. UAD requires the appraiser to note in this part if there were updates to the kitchen or baths only within the last 15 years. So if you see no updates in the prior 15 years, that doesn't mean there have been no updates to the property at all. It simply means there have been no updates to the kitchen or baths. If there was a new roof put on 3 years ago or a new heating and system installed 5 years ago, the appraiser should note that in a separate comment. The property on the screen had updates 6 to 10 years ago for both the kitchen and baths, and there's a separate comment afterward stating no other renovations were observed. While updates to the kitchen and baths are reported separately here, they're also considered in the overall condition rating for the subject.
You know, Christy, oftentimes I hear that a borrower spent $40,000 remodeling their kitchen, but the appraiser didn't give them full credit. Why is that?
That's a great example where the cost of the upgrade does not translate into value. More often than not, the cost to construct or upgrade an item will cost more than the value it adds to the home. While a brand new kitchen will have an impact on the value, it will not be dollar for dollar. In this case, it would be compared to other properties that also had remodeled kitchens of similar quality. This will reflect what the market value of the improvement is. Most times, cosmetic upgrades are a matter of personal preference and not necessarily recognized by the market. Homeowners sometimes create over-improvements, which is where the expense of improving the property is excessive in comparison to other properties in that market, and it won't be financially recouped. I heard one case where a borrower put in a 24-karat gold faucet and wanted to know why there was no added value for that in the appraisal. The answer is that's not something a typical buyer cares about, nor would they pay extra money for.
And you know, another important factor that most borrowers don't realize is that any improvements that are not permanent are considered personal property and not valued in the appraisal. Examples of this would be an above-ground pool, or a shed that's not on permanent foundation, or a marble bird bath. These items would not be included or valued in the appraisal report.
You guys are always disrespecting my bird bath collection. Okay, let's move on. Our next question centers around properties with work being done or needing to be done. The dreaded subject to. Christy, our number 3 question is a multi-parter. What are the most common reasons an appraisal would be completed subject to? Does the appraiser need to go back out? And do I have to get a professional to do the work, or can the borrower just do it?
An appraisal will be completed subject to when there are existing conditions that affect the safety, soundness, or structural integrity of the property. Common examples of these items that would require repair are cracks in the foundation, an active leaking roof, exposed electric wires, or peeling and chipping paint on properties built prior to 1978. Minor conditions or minor deferred maintenance and cosmetic items won't require the appraisal to be subject to. FHA does have stricter requirements with this than Fannie Mae, so if you're ordering an FHA appraisal, be aware of that.
Right, and to answer the second part of that question, the appraiser will almost always have to go back out to complete a final inspection once the repairs have been completed. Some items the underwriter can approve without a final inspection, like reviewing a roof cert. Other items will require a professional, such as a plumber or a roofer. And sometimes a survey is needed to determine distances between a well and a septic. There are items that the borrower can complete themselves if they're capable, like putting a railing on a porch or scraping and repainting areas with chipping paint.
You know, one of the things loan officers and processors really have a hard time explaining to a borrower is how is it possible that an appraisal done today has a lower value than the one they had done a year ago, especially when it showed overall sales prices were increasing. Our number 2 question is, how can the value of my property go down when the overall market is increasing?
You know, Kevin, I agree with you. This is a tough question, and it's very difficult to explain to a borrower. The section of the appraisal that reports information on the neighborhood is referring to the entire market area, not the subject specifically. The purpose of this is to provide the lender with a clear and accurate understanding of the market trends and conditions prevalent in the subject neighborhood. Whether the market is stable, increasing, or declining, the appraiser must use the most recent and similar sales to determine the current market value of the subject, not the entire market area. Christy, as an appraiser, why don't you walk us through a real-world example?
Let's say I recently appraised a home in Philadelphia. I selected 4 comps that have sold within the last 3 months. They have a sale price range from $200,000 to $225,000. My final opinion of value is $215,000. I submit my report. Then I get a call from the lender explaining that the borrower had an appraisal completed a year ago with the value of $230,000. They send me the report to review. I see there were 4 comps used, all sold 12 to 18 months ago. The sale price ranged from $215,000 to $240,000. The sales were current at the time of that appraisal, however, they are not today. If I use those sales, the underwriter would reject them immediately and ask why I didn't use the more recent sales that are available. The current comps that were not available 1 year ago but are today have a slightly lower sale price range, which is reflected in the market value for the subject. However, this does not indicate the entire market has a lower value. If the most recent comp sold for lower than the comps available a year ago, it's going to impact the value for the subject specifically. The market may still be stable overall. Oftentimes when we see this, the decrease is less than 10%. That's not really showing a declining market, rather a minor variance in the most recent sales prices for properties similar to the subject, not the entire market area.
You know, another reason for this, which is sometimes difficult to understand and then explain, is that appraisals are opinions. Most likely, if there are 2 appraisals within a year of each other that differ significantly in value, chances are they were done by 2 different appraisers. It's possible their opinions of what sales were most appropriate to indicate value were different. It's also possible one appraiser made a mistake and missed market data or mismeasured the property.
When we come across this scenario at NAN, we review the reports against each other for discrepancies and errors. If both reports appear accurate and supported, with the only significant difference being their comp selection, we suggest ordering reviews for each appraisal to determine if one is not credible. I know it's hard to believe, but the appraisal with the higher value is not always the supported one.
Very interesting. Okay, so before we finish up, I'd like to take one last quick poll. Did you guys find the information in this webinar helpful? Give me a second while I switch over to the poll question, and if you would kindly submit your answers, we can move on to the number 1 question. So, did you find this webinar helpful? Yes, somewhat, no, or do you wish we covered more content or perhaps other information? All right. Got a couple more answers coming in. All right. I'm going to go ahead and close the poll. And then, Kevin, I'm going to hand it back over to you for our number 1 question.
All right, here we go. Now, Christy, you being an appraiser, I know this may be hard to believe, but not all appraisals are perfect.
Say what?
So what does a loan officer or processor do if they find errors or they have concerns about the appraisal? Our number 1 question is, what is the best practice for disputing an appraisal? And is it really worth it to go through the appraisal, or excuse me, the dispute process?
I definitely think it's worth it to go through the dispute process if you have reason to believe the appraisal is flawed. I see and work on disputes here at NAN along with our other staff appraisers and receive positive feedback from our clients. They appreciate our knowledge and ability to work with the appraiser to resolve any concerns and answer questions. If additional sales are provided, appraisers will review them to see if they may have initially overlooked them and determine if there are similar properties to be able to add to the report. They'll respond to other questions and provide additional data to support items in question. In the end, the ultimate goal is to either provide a revised report if information was missed or errors were made, or to provide an explanation to the lender addressing their concerns.
If you do decide to dispute an appraisal, first, gather data including errors found and any factual support for your dispute. If you believe the appraiser selected comparables that were not the most similar, submit a list of closed sales to be considered. They should be as or more similar than the comps the appraiser initially selected. Don't submit active or pending listings. A common misconception is that these represent current market value. when in fact they only represent what the owner decided to list the property for. If you see a house across the street from the subject that is listed right now for $30,000 higher than the appraised value, that does not indicate market value. Until it's sold, the market has not accepted that price. Nobody knows if it will sell at all, or if it does, at what price.
At NAN, our appraisal dispute process is simple. We track all requests within our portal for each file individually. All you have to do is log into the portal, find your file, click on the appraisal dispute form, and follow the instructions. As you can see on the form, we have included instructions and examples of best practices for using the form properly. You have plenty of room to provide details and to supply additional sales and/or insufficiencies found in the appraisal. Feel free to attach information in the file upload section as well. Now, once you hit submit, the file will be passed along to one of our staff appraisers who will review the request, contact the appraiser, and work towards resolving the discrepancies and communicating with you along the way, all in a timely manner.
If you go through the dispute process and you or the borrower are still unhappy with the appraisal, there are a few options. First, you could order an appraisal review, which is when another local appraiser reviews the report to verify data and provides their opinion on the comp selected and value provided. You could also order a full second appraisal, which is completely separate from the first appraisal. This would give you a fresh report from another local appraiser to determine their own opinion of value. Generally speaking, if appraisals are completed around the same time, the values should be within 10% of each other. Remember, appraisals are opinions, so the values will not match exactly. An important thing to keep in mind if you do choose to order a second appraisal is appraiser independence requirements, or AIR. AIR only permits a second appraisal to be ordered once one of the following have been met. The first appraisal is flawed and reasons why are clearly documented in your file. It's part of your pre-established appraisal review or QC process, or where it's required due to loan product or by law. Make sure you have these bases covered if you do choose to order a second appraisal.
All right, well, we made it through all 10 questions, I think, successfully. So thank you both so much for lending your expertise to our audience during today's webinar. I know we covered a lot of information, and we hope that everybody was able to find value in our discussion today as well. I did want to take a quick minute to invite everyone back to NAN University on our website, nationwide-appraisal.com. Here we have more helpful and informative webinars, white papers, and checklists that you guys can start using today. As a reminder, we will be sending out an e-guide to assist with training and to use as a reference when reading and understanding appraisals in the future. And with all the information we provided to you during today's presentation, we decided to take all questions offline. We encourage you to please send us an email with any questions you may have that we didn't cover today. We're happy to include this Q&A in the e-guide email that we're going to send out to you as well. It's sales@nationwide-appraisal.com. We hope to see everybody at the next webinar, and thank you, and have a great day, everyone.
Bye.
Goodbye.
Bye.